All right, so the markets continued yesterday's rally into today. Again, kind of pricing in what's going on overseas with this war in Ukraine and the Russian invasion of Ukraine and how they're responding. It looks like it's probably not going to be as easy as maybe Russian officials may have thought it was going to be. And we'll see how things end up going here over the weekend. But the market so far, having priced in the news of this conflict in a bearish manner, has now that the conflict has now started to give back, right? Start to get back some of those losses. But now we're going to take a look at whether or not this snapback rally has been trend changing or not. To see whether or not we are still in this bearish mode or whether we have been able to break out and break through, and what today's range and volume looks like and what that tells us. So I'll give you an idea of what I expect next week. I am going to be out next week, so today is the last market outlook until next Friday. I'm going out of town to where it's sunny and warm, and so I'll be back next Friday. And so until then, I kind of give you an idea of what I expect the markets will do next week until I get back, and we can be able to talk about next Friday how the markets responded. So let's go ahead and get started. Today is Friday, February the 25th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Nice little rally, short-term rally here, two-day move to the upside, basically up to 38% retracement of the decline that we've been having after opening up yesterday, rallying up, and then today finishing this move. You can kind of see too on this near-term decline right here. If I were to change the colors on this, you can stand out a little bit more. This near-term decline, you can see we are essentially up towards that 78% retracement. Remember, getting through that changes the near-term direction from being bearish to being bullish, right? Because this is obviously a lower near-term low point, and as of right now, it would be a lower near-term high point unless we get through 78 and then 100 and get up to the upside. So, but on the longer intermediate term decline here, we are sitting right at that 38% Fibonacci retracement level, well below still the 30-day moving average. So again, nowhere near dark green shading and a green line, which is what you get when you change the trend around. The near-term line did jump into the upper reversal zone, but barely, right? It did not get above the 90th percentile, which is what you would like it to do if we're going to turn this around. We are not so far below the 30-day moving average anymore, but we are still 1.5% below. We were well below there, getting the red dots, and you can see you get those red dots, and we kind of bottom out there. The red dots suggest a 10th percentile or less of how far down we are below, in this case, in the past year. So this has been the most bearish we've been in the past year, and really, it's been the most bearish we've been since COVID, right? Because if you come over here, since the COVID drop, we had a couple of drops here in September of last year that was this low, close to being this low, but not quite. So the momentum line did rally to extreme highs. That's a good sign. Not surprising when you consider, again, significant bullish moves, slightly above average on the range. We filled in the gap, so we don't have to account for that. Slightly above average on the range, and then when we look at the volume here with the three green arrows, with the MACD rising, if I were to take a look, you can see we still got dark pink shading everywhere except for IWM. IWM actually has three green arrows. We had three green arrows over there briefly before we turned around. So we'll see if this ends up being a 1 week phenomenon. See, when you're bearish, you will get these, but it will only typically last about a day or two. So we'll see if that ends up being the case this go around. Three green arrows, light green shading, and a yellow line suggest. I mean, that's a pretty decent selling opportunity, considering that we're also at that 23% retracement level there. The MACD histogram for all the others are at least rising. We're still light pink shading, which means we're still three red arrows, but at least the MACD is rising for all of these. And you look at today's volume. Again, a very good range, slightly above average, but slightly below average volume. Not really the best thing. You typically like to see, continued strong volume above average when you're coming off these lows. So the fact that we would drop down to a much smaller range than what we had yesterday, 18 points yesterday. Today is only 10 points. And the average is 9.5. So, I mean, 10 sounds like a lot, but we have to compare it to an average. We have to normalize it. So we compare it to the average, and it's really not that much. And then you can see not very much volume either to support the rally here, this strong rally that we're getting. Let's take a look at the weekly charts on the market forecast. So we'll go to the weekly here. And you can see here the intermediate line is in pink territory and turned back up again, hence the green shading up there. Can't really see it very well. Long lower shadow on this week's candle. Very long lower shadow. We had a long lower shadow over there and was relatively bullish, and then started to fill in that gap this week until we rallied. A long lower shadow again, that's very bullish to get a long lower shadow on one hand. On the other hand, we can also trade within the range of that long lower shadow, especially considering that we have just barely started a pullback here on this basis, right, on this long-term basis. You can see I mean, we haven't even dropped, like the low point got below the 23% retracement, but we're well above the long term. So when you look at it from this perspective, we've hardly retraced at all of this rally that we have. Of course, the Russell has retraced a lot more. Its intermediate line we actually got a weekly cluster, so it's we got dark pink shading and a red line. We are below the 23% retracement, which also happens to be the 38% retracement of this intermediate run that we're on right now. Push it down there. So they're sitting right on top of each other. So there will be some pretty significant support right around that 2110 level. The near-term line is moving higher, but not significantly higher. Hardly a great bullish move here, and barely above the 23% retracement there, and still well below that 30-week moving average. Your Nasdaq 100, you can see again, its intermediate line, is down in the lower reversal zone, close to the lower reversal zone. Small bounce in the near-term basis, long lower shadow again. But still below these important Fibonacci retracement levels. 23% on that big long-term move, this one, right? So there's a 23% retracement level, and then the 23% retracement of this intermediate run that we had. Now we need to move this down to here, so that's where the 38% again is sitting. So very strong resistance in a very short term right now for some of these indexes after the nice little rally we've had over the past couple of days. Let's take a look at the this crossover chart. You can see we haven't got the death cross yet, but you can also see the Hakinyashi close is well below the 200-day moving average. Now, granted, we're going to end up with a pretty neutral, like a neutral candle like this next week. We'll see if it turns bullish or not, because we're going to open up right around 43.66 and we're trading at 43.84. So we'll at least get a long upper, at least an upper shadow. So we'll at least get this kind of candle, if not a new. If we don't drop below 43.66, a bullish candle. And then we'll watch for the green arrow to get back above that moving average there. The Russell 2000 is easily below, nowhere near flirting with getting back above there. And then your Nasdaq 100, we're getting the death cross right now. And we are the Hakinyashi close is well below the 40-week exponential moving average. And when I take a look at this chart, the 3 green arrow chart with the 2-line versions, you can see that today we did get on the S&P, we got above the 8-day moving average, and we're flirting with the point of control. You can see the 30-day is crossing below. There's going to be some resistance. We haven't got above the 17-day yet, so there is going to be some resistance at the 17 and probably at the 30, especially at the 200. And if we do break above the 30, then watch for a move up towards the 50. That happens quite a bit after the 30-day crosses the 200. So it is not surprising at all now that the 30 is crossed that we're getting a bullish move, and I would expect the same thing in the Nasdaq. You can see if it gets above the 30 and it gets above these Fibonacci retracement levels, which is probably where the 30 will be by the time it gets there. If it does break that resistance, it's still got to get above the point of control and the 200-day, which by then your 50-day will have crossed below that. So you're going to end up having some pretty significant resistance there on the Qs. And of course your IWM is well below. It is above the 30, so I do expect we'll trade up towards the 50 on the Russell over maybe not like Monday or Tuesday, but by the end of next week we should be making a run towards that level with the MACD and the stochastics turning up higher. If you look at the weekly versions of this chart, you can see, as bullish as we've been, we're still below the 8-week. The 8's below the 17, the 30's crossed below the 50. We are in correction mode. We're about halfway between the 50 and the 200. Full-on correction mode here. SPY is not. SPY is still barely below the 50. It's got a long ways to go to correct down to the 200. And then the Qs, we're a little bit more below the 50. So we are in correction mode, and it's going to take a pretty significant move to beat that. But it's also got a long ways to go to the, probably will end up getting down to 258 by the time all is said and done, towards that 200-week moving average. So just be aware of that, as that, the MACD, remember, looks bigger than it is than it was these times, because the price is about double what it was those times. So keep that in mind. The MACD is an absolute value, not a relative value. That's why the PPO works so nice. Let's take a look at some of these other oscillators. So your DMI, again, this doesn't look bullish at all. Like, we're still easily above 35 on the negative indicator. We're still easily below 20 there. The Q, same thing. I mean, that doesn't look like a bullish crossover. And then IWM, same thing. So I mean, we got to get the positive above 25 before we even think about being bullish. And even then, it might just be temporary, like that one was. All right, so keep that in mind if you're thinking that this is a bullish rally right now. When you look at the RSI and the CCI, we're not above 60 yet. We're not even in the upper half of the chart on the S&P. Definitely not in the upper half of the chart on the Russell, and not in the upper half of the chart or on the Nasdaq or on the Russell either. So we're not bearish, but we're also not really strongly bullish either. And you see that in some of these trend strength indicators. We still have a pretty decently strong intermediate trend going on S&P. If you look at the Qs, it's a very mature trend still, despite the rally on the Qs, and IWM is in a noisy pattern right now because it's been more up and down, and less down than some of these other charts have been, but obviously not bullish yet either, and well below the cloud. And again, I've always said this, when you are in bear markets, you get your biggest down moves, right, when you're bearish. Like, this is the day, the Friday after Thanksgiving. That's when this bearishness started. We ended up getting a new high early in the year on the S&P, not on the Russell, but on the S&P. But it really started that Friday after Thanksgiving, and you can see we've had the biggest bearish move since. But you also notice we've had our biggest bullish move since, and that's just the norm. That's how it works. You'll get really strong bullish moves. That doesn't necessarily mean that things are bullish. In fact, you can see we're barely below 100%. Now, I do expect volatility to drop a little bit here next week, so we might rally up and work our way down towards 95. I don't expect that we'll go too far down to the downside on volatility. It's a nice good move there to get back below 100%, but we're still pretty darn close to 100%. And we still haven't washed out yet, which is, for the kind of corrective move that we're in right now, would be a move above 125%, and we're not anywhere near that level. And since we didn't start this correction with that kind of move, most likely it's going to happen at the end of this corrective move, like we saw in the fourth quarter of 2018. Looking at today's range, intraday range here, right here, you can see we did get a higher high, higher low, close above yesterday's high, close above last week's low point. So that kind of took away the bullishness. Interesting that whenever we have these kind of declines, and this is from Steve, he has shared this nice good chart, talks about the times that we have traded down 5%, and then on the week, at one point in time and during the week, the S&P technology, XLK, was down 5%, but then finished green. So we just had this in January. You can see some of the other instances during the financial crisis in 2018, at the beginning of the corrective move in 2015, during the bear market in 2002 when things really hit the fan, at the beginning of the bear market in 2001, after we had a correction, we were failing the bounce and started, and you can see at the very end, at the very beginning of that correction in 2000. And then one last one there in April 30th, 1999. So, when we've had those big declines, but then finished up, so long lower shadows, here's the drawdown. Like, this is the drawdown. Here's the returns 1 week later, on average 5.6% down. 2 weeks later, we're down 3.5%. 4 weeks later, we're down 10% on average. Right now, the last couple haven't been so bad, and you can see these are all kind of bear markets, but those are pretty pink numbers, and the maximum drawdown during the 4 weeks is about 14.5% on a low, on the intraday low, and 12.5% on the lowest close. And then the biggest rally we have is 1.5% to the upside at the high, right? With a minus at the highest close, still down 1.5%. So this basically tells you that when we have weeks like we had this week, that's not necessarily a good thing. It typically leads to more bearishness going forward, at least in that particular sector. We'll see how it impacts the broader market, considering that that sector is the biggest sector right now in the broader market. So that's kind of the idea behind that, and I showed you the volume and the range. We were a little bit below average on the volume, a little bit above average on the range, but we're at that 2%. You know, again, we kind of wash out when it hits up to that 2.5 to 3% on corrective moves, right? This is an intermediate declines typically stall at 2%, but not corrective moves, and that's what we're in. You can see IWM is actually sitting near 3% on its ATR, and the Qs are above 3%. So I expect SPY will probably get there too, near that. By the time, again, all is said and done, and we get the spike and volatility that we just haven't gotten yet. So I expect next week that we'll probably, excuse me. I expect next week that we'll get, you know, we're probably in the very short term right now, we're sitting at some pretty significant resistance in the short term. So early next week, it might start off on the bad foot. But by the end of the week, we probably will finish a little bit higher than where we finished this week. Not significantly higher, but up towards those falling moving averages, 30-day, 50-day in the IWM. Probably will spend another week or two working towards those levels before the market reshifts its focus back to from Russia, Ukraine, from geopolitical to the Fed, right? And that because we got 3 weeks before the Fed makes their announcement with a really important inflation report before that. So that's the problem that the market is more concerned about, not this geopolitical issue. And we just haven't been that hasn't been a focus yet. In fact, the focus has been, well, maybe because of this war, the Fed won't raise rates. So we'll see what ends up happening. Unfortunately, this war doesn't necessarily, doesn't damp down inflation levels, which is what the Fed is really concerned about, considering that the real Fed funds rate is near negative 7%. So I think, we'll get a little bit of a buy the rumor, sell the news with this geopolitical mess. We all are rooting for the Ukrainians, and our hearts go out to them. As some of you may be listening, across the world, I think the Ukrainian people have really kind of showed their mettle and showed who they are, especially some of the leadership there, with how they've responded to this, and it's definitely been courageous, and we hope for the very, very best outcome out of there. But from a market standpoint, the market had been pricing that in, and now is buying the actual news, as bad as that sounds. And then now that it is a part of reality, see, the markets don't like uncertainty. So as long as there's this war is a reality, then the market can do something about it. But when it's uncertainty, then we have volatility, as we've seen. No more uncertainty. It is what it is, and the market is discounting what it is. Now the uncertainty will shift back to the Fed. What will they do? Right? What do they have to do? What do they need to do? That's going to be the big focus after we get through this next week or so of pricing in what's going on overseas. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that tell you why you should be either a lot more bullish than what I've shown here, or why you should be a lot more bearish than what I've shown here? Post those in the comment section below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen, hit the red subscribe button that pops out. There's also a subscribe button down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. So number one, of course, you liked our video today. And number two, it's a way to tell us that you want us to do another one again on Monday. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't like it. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments you have about anything I put out there? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including the Market Outlook Live video. Click on this icon, it takes you to this page. This is where I do the Market Outlook Live every Monday, Wednesday, and Friday when I do the Market Outlook. I do it at 3:30 Eastern Time on this page. You can see usually there's a chat window up here as we're running the class. What we do is we review all the trades that we've done in prior Market Outlook videos to see whether we should stay in them or not. And we add on our new trade, the one you'll hear at the end of the video, we put on today already before the market closes. So that's where we do that. Come down here, you can see our upcoming classes. If you click on the View More, it takes you to our calendar, and you can see all of our upcoming classes as well as our prior recordings. There, you can check that out. You can get to it up here by clicking on Trading Rooms as well. Come down here at the bottom, click that heart. It opens up this tab. Hit that like button. Also click on this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps us get our content out to more of our followers based on how Twitter and Facebook algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at what's driving the price action here. And let's go to the beginning of the week, because remember, we were down 5% at one point this week. And it was a holiday week, no less, because there's only 4 days this week. So at one point in time at the low, we were down well over 5% on QQQ, well over 7% on EWM, or EEM. EEM still finished down almost 3 by the time all was said and done. Not surprising because Russia is a big part of that. But you can see by the end in commodities spiked up 6% there. Gold spiked up 2.5%. The dollar spiked. They stayed higher. Commodities finished about 1.5%. The dollar finished relatively high. Gold came down after a drop midday yesterday. But U.S. equities rallied sharply. The Qs rallied, the S&P rallied, IWM rallied, real estate rallied. They all finished the week positive. If you were to go back again to when this all started, right, the Friday after Thanksgiving, you can see why those rallied the most, right? Because, I mean, they're still down 12-13% from that Friday, from the open on that Friday after Thanksgiving. I mean, it kind of gives you an idea of what kind of market we're in right now and why they rallied so much, because they were down so much. And same thing with emerging markets, actually had been holding up much better until the last couple of days, not surprising. And now they are about looks like right in this area here, right about where long-term bonds are. See, interestingly enough, the dollar's outpacing, currencies are outpacing everything except for gold and commodities. And long-term bonds are way down here too. Long-term bonds have really been moving higher. In fact, I took a look at this today in my class. We finished the day a little down to only 1.57%. One point in time we were at 1.61%. But if you take a look at where we've been here over the past month at 1.57%, you can see while the odds of a rate hike of a 50 basis point hike have dropped since the beginning of February, the odds of the bond market's odds for a rate hike, a 50 basis point rate hike, had not dropped. In fact, they're still just as high as they were when we spiked, when we had this spike right here in the that spike right there in the Federal Reserve, when we were 60 to 90% odds of a rate 50 basis point rate hike. So it's interesting to see, and you also see too that the yield spread between the 10 and 2-year note is still at 40 basis points. Very important level. You break 40, we head to 20, right? It kind of goes in, 60, 40, 80, it goes down to those levels. So we just broke 60 here recently at the beginning of February. We broke 60 and we made our run down to 40 now. So now we break 40 and we'll make a run down towards 20. And again, the Fed has not even raised rates yet. And you're already this close to an inverted yield curve. So that's going to put a lot of pressure on the markets. Usually an inverted yield curve usually kind of ends bull markets when the Fed raises them so fast. So remember, the Feds were coming off of a real Fed funds rate of nearly negative 7%. We'll get a new inflation report right before the FOMC meeting. So it's a little different scenario. I mean, you have to go back to the late 70s to have a Fed funds rate that low, and when we were in the late 70s, the Fed funds rate was not at 0%, it was in double digits. So it was still a negative, strongly negative with how high inflation was, and they raised rates sharply to be able to offset that. And that's why, like, again, they might feel like they have to raise rates pretty sharply again, even with a near inverted yield curve between the 10 and 2-year note. Let's take a look at some of these charts like long-term bonds. Excuse me. Take a look at TLT here. You can see it's sitting below the 8-day moving average. The MACD is above its moving average, but we're still below the 17. So we're still kind of basing right now. We're not diverging to the upside, but we have a death cross, the 50 below the 200. We are below the value area for the 1 year on the 1 year chart. If you look at the 2-year chart, we're near the bottom of the value area. So this would be if we were to break this 135 level, that would be pretty significant. But you can see why we're basing here, because it's a pretty significant support for long-term bonds. TNX, which is a 10-year yield, you can see it's sitting right around 2% there, well off of its lows when we were down towards 50 basis points. Coming off the COVID bottom, we were up to 2% now, and the Fed hasn't raised rates at all. So it kind of gives you an idea of the market's expectations for rate hikes. In fact, when you look at this chart, the yield curve chart, it's pretty rare. Let me show you here. The last time that the Fed started to raise rates in 2015. The end of 2015, you can see we started to price that in relatively early, and you can see the short-term rates rising off of 0%, right? But look at them now, right? I mean, we are pretty darn high here. I mean, we're higher now than we were at the end of 2016 when we were pricing in the second rate hike. I mean, we are right. Look at the purple line. The purple line is a 2-year note, right there near 1.6%, right? It's the highest level it's been since 2017. We were well into rate hikes by then. We haven't even started yet. So the market's really pricing in a much faster speed of rate hikes now than we ever did in 2015. You can see we are gradually moving higher in 2014, and then finally in 2015, the Fed gave the market what it was looking for. And then in 2016, again, the Fed gave it the second hike, and then it's continued throughout 2017 and into the end of 2018. That's when the Fed raised rates. It's the last time. Then we had the rate cuts in 2019, and then of course down to 0% after COVID. So it's a pretty steep rally, much steeper than what we saw previously. And you can see here's 2004, so June 2004 when we were raising rates. That's where it got to. That's how fast it rose before we finally raised rates the first time. But again, the real rate then wasn't nearly as low as it is right now. And inflation expectations, when you look at inflation expectations here, we haven't looked at that for a while. But here's the 5-year break-even inflation rate. So here's the 5-year inflation rate, and there's 2004 back over here. We're kind of about the same levels over here, 2004. We kind of got to those same levels, but we're higher now than we were then. It's a very strong move in that inflation rate, much higher levels of inflation than what we've seen in a very long time. So of course that's impacting Fed policy, because the reason why they were able to keep interest rates so low for so long is because the inflation rate stayed down. That's not the case anymore. It's higher than it's ever been, according to this particular data point. You remember back here, we weren't coming off at 0% like we are right now. So the real rate is much lower now than it was back then in 2004. And the markets were bullish in 2004 to 2006, relatively bullish. They had a pretty decent run. It wasn't the greatest run, but still it was better. Like it did rally. If I were to take a look at this long-term chart and go out the 20 years, there's 2004 to 2006. We started to raise rates right here in June. So we had a little bit of a decline there. Here, let's take a look at it this way with this chart, and then let's go 20 years weekly. So here's that June 2004 right there. So we were just barely getting above the 200-day moving average, 200-week moving average, coming off of that bear market low point. Just barely getting above it, and the Fed started to raise rates, and we had a little bit of a correction down towards 200, just a little one because we weren't very far above it. And then we rallied. We hit a few little pullbacks in 05, and then there's where we ended the rate hikes in June of 06, and we had a little bit of a pullback, a relatively deep pullback there. And then then we stay pretty bullish going into the peak in '07. The inverted yield curve happened over here too. So a little different scenario now. Right now we're raising rates. This gap is huge. We've been above the 200-day since we dropped to zero for a long, or 200 week, excuse me, for a long time. Like we got back above the 200 week in a matter of 3 weeks. So that was hardly, that big of a deal by the time it was all said and done. And now, the Fed's got to figure this out. I mean, that's the biggest gap between the 50 and 200 week moving averages that we've seen since the late 90s. And the interest rates are at 0%. The interest rates in the late 90s were not at 0%. If you look at the historical here, if you go back to the late 90s to 99, 2000, you can see they were raising rates into early 2000 up to 6.5%, the Fed funds rate, and the Fed funds rate right now is at 0%. So that kind of gives you an idea of why the Fed, why the markets are still a little concerned, and why this won't be your typical rate hike cycle for how the markets respond to it. Let's take a look at how the sectors are moving here today. So let's look at the 12 grid here. Remember, we talked about technology just really sharply dropping and then bouncing. Everything kind of looks the same except for energy. Energy is still rising above its dark green shading and green line. Everything else is light green shading at best and yellow line at best. So still relatively bearish, not as bearish as it has been, of course. But that's not, we don't have dark green shading and a green line yet. And if you look at how things have moved this past week, so let's go to the comparison chart and go back to just this week alone. Then you can see again, we started off with discretionary and technology down quite a bit. Financials were down quite a bit. By the end of the week, staples and financials still struggling. Discretionary still lagging behind pretty sharply. Everything else positive. Real estate, utilities up positive. Healthcare. I mean, this is technology and communication services rallied too, but your safe haven areas ended up outside of staples held up much better. Interest rate sensitive areas too, and utilities and real estate. So interesting to see that as bullish as we were, not quite as bullish as we can be, partly because they held up so well, right? If I were to go out to just the past couple of days, you can see technology, discretionary, communication services, real estate, all the biggest winners off of that low point from yesterday's open. And then you can see financials and energy lagging. Not surprising, they've been really bullish, and they're lagging along with staples also lagging there. But again, this is more of an extreme oversold technical bounce, because if you were to go back to that Friday after Thanksgiving, they were down the most. So not surprising that they bounced the most in the last couple of days, because they were down the most. Energy's been up the most, not surprising that lagged. So these trends haven't changed yet. They're still pretty sharply lower. The S&P, we haven't turned higher yet. So just because we bounced in the last couple of days doesn't mean the trend has changed. I don't think it will have changed, or it's going to change here before ultimately we finish this corrective move, which could take weeks, if not a couple of months, by the time it's all said and done. All right, let's take a look at our trade idea of the day. Remember, we already did this. We already put this trade on before the market closed today during our Market Outlook Live video. So there's that link that popped out up there that takes you to that page. You can see that Cisco has had a nice little rally too, not very bullish. Like, it's still below its moving average. Didn't really drop very much before that. Its intermediate line is in bearish territory. It's rising, but not really significantly. The short-term sentiment not nearly as bullish as what we saw in the broader market. If you take a look at some of these other charts, you can see here on the weekly chart that we have bearish, neutral candles, but we're back to a red arrow there. So you can see we've closed back down below the 40-week after briefly rising above it last week. If you take a look at some of these other oscillating charts for Cisco, you can see the negative indicator is still above 25 though falling. The positive indicator is still below 25 but rising, and they're pretty close to each other, so that shows how neutral it is. When you look at the RSI and the CCI, they are both in neutral territory, not below 40, not above 60, not below 100, negative 100, or above positive 100. When you look at the trend strength indicators here, you can see we are below the cloud, though we are flirting with the blue line. We still have a mature bearish trend going, though it appears like we might be stalling that. If you look at the Bollinger Bandwidth, we are right in the middle of the bandwidth again. After being bearish, we're right back in the middle, flirting with, or trading right around the point of control. It's a pretty tight range for this past year in terms of volume. That's what the orange lines tell you. It's seven. This is where 70% of this year's volume is taking place. So you can see it's a relatively tight range there um, that we have going on. And so you can see the blue lines I've got. So what I've decided to do is that we're going to come over here and we're going to do an iron condor spread. So we're going to sell the low 20s on the delta. So we're about 2 strikes away, 58.5 to 60.5. Then we're going to sell on this side of the low 20s delta, sell the 53 by the 51. We ended up getting 50 cents out of it. This is what it looks like in the risk profile. So those blue lines are sitting right on that chart there. So when I look at the Bollinger Bandwidth for Cisco, as long as we stay around this point of control now that we're through earnings, and you can see we've been around these blue lines, inside these blue lines for a lot of different expiration cycles. We got out of it at the very end of the December expiration cycle, but by the end of January we're back in it. Right, and then we've been in it ups and downs through February, and now I expect that we will also be in it through March. Of course, if we drop down, we've got plenty of bearish trades that will more than make up the gap for that. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there. If there are any questions or comments you have, reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video below. Also subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook as well. And again, like I said, the comments are appreciated. Have a great rest of your weekend, everybody, and a great week next week, and we'll see you all next Friday.